Hi, I'm Dr. Jeff Camarda, this time talking about value investing. Is this the next leg of the bull market? Now, it's no secret that value investing, Camarda's preferred strategy, has been out of favor for much of the 21st century. While Camarda has been very proud of its value style results in a strong stock, Columbia, and Viking portfolios, we truly believe the best is yet to come, and the next decade, or even longer, could be a period of extraordinary profitability for value investing styles. First, some context. Besides looking to pick up assets for less than their worth being intuitively appealing, buying dollar bills for 60 or 70 cents is a good metaphor, value investing has the strongest academic evidence for long-term superior results. For instance, data collected by Nobel Prize-winning economist Eugene Fama and Dartmouth finance professor Ken French indicates a long-term, nearly 100 years, annual compound rate of almost 14% for value stocks, or about 40% more each year than a growth portfolio's 9.2% average return. For a $500,000 investment over 10 years using those returns, value would return under normal conditions, or historical conditions, $1.7 million compared to growth's $1.2 million, or about $500,000 or 100% more total return on invested capital of $500,000. Over a study period of nearly 100 years, large cap value has beaten an index approach by over 2 to 1, and a large cap growth approach by 7 to 1. Large cap growth being FANG type stocks like Amazon and Alphabet, Google, that kind of thing these days. That's on average, but I think we may do even better in the years ahead. Note also that a small cap value approach, a style often used in Camarda's Columbia portfolio, has beaten an index approach on average by some 10 to 1. These are pretty huge differences, but to harness them, history counsels patience. These have been long-term effects and can be easily lost in the knee-jerk noise of what's hot lately and what's coming around the next quarter. Since so much of the human mind is hardwired to make decisions on recent information, it's a bear! Run now! Dry, long-term data can be discounted, forgotten, or even ignored by the emotional brain, resulting in poor choices and inferior long-term results. So patience, discipline, and an ongoing awareness of your long-term objectives and best interest is the key to targeting superior returns. Think Warren Buffett, really the godfather of value investing. What we learn, and these are quotes from him, what we learn from history is that people don't learn from history, he said. Long ago, Ben Graham, the true godfather of value investing, taught me that price is what you pay, but value is what you get. And Warren says, whether we're talking about socks or stocks, I like buying quality merchandise in good shape when it's marked down. In the short term, the market is a popularity contest. It's a voting machine. But in the long term, it's a weighing machine. So make sure you get good value for what you're investing. Ignore, even disdain, what is popular, and make sure you get ample measure for what you pay. That is the essence of value investing. What's more, given the out-of-favor recent history for value, indexing and tech growth stocks have dominated investing fashion for most of the 21st century so far, the stage could really be set for some truly massive gains ahead. This could be awesome. The Fama-French data also show that out-of-favor periods, like recently, for value are usually followed by strong, sustained periods of dramatic value outperformance. More data from Fama-French, collected by John Buckingham, the author of one of my favorite newsletters, recently tells that story. Going back as far as 1932, value typically outperforms in most periods, but when it doesn't, around the 2000 dot-com crash for instance, it typically roars back with outside gains, in that case nearly 100% more than returns for growth stocks. In many ways, the current market is similar, with tech growth stocks dominating the field and trading at dizzying valuations. Nobel Prize-winning Yale economist Robert Shiller, who you may recognize as the author of Irrational Exuberance and predictor, he called the dot-com crash and the 2008 real estate crash, recently said the only time we've had a higher valuation than where we are now was around 1929 and around 2000. right around the dot-com crash. It's important to note that value stocks, almost by definition, can remain attractive bargains in frothy times like this, and that may go double really for today. The recent value underperformance is one of the strongest on record, and the exceptional upcoming returns for value that it could be signaling could be truly historic. Patience and discipline are powerful keys to wealth. Please remember to keep them firmly in hand. This is very, very important stuff, folks. I hope that you internalize and use it to guide your long-term decisions. Wishing the very best of affluence and wealth. I'm Dr. Jeff Camarda. Until next time, thanks so much for watching.